So I'll start by wishing everyone a happy new year. I know it's a little late for that, but given that this is the first time we're getting together, a happy new year. This is the January update of Refashion Seed, the rolling fund. Our plan is to do these once a quarter after we've had a chance to update what's happened in the previous quarter. But this is the first time that we're doing it. So this is an overview of the past 6 months of our activity.
I think you have to page up or page down. You can't click. There you, oh, you're at the end of the deck.
Oh, okay. Apologies. This is what I get for talking instead of setting things up. Okay. So the plan is to do a quick portfolio update. Then we'll talk about fundraising. We'll talk about the macro environment. And then if there are still questions at that point, we'll do an open session or Q&A. Demo, could you mute yourself? Thank you. So between July and December of 2021, we made 9 investments. These are the 9. And the investments range from some pre-seed investments to 1 pre-series B investment. I'm not going to go into a lot of detail on each one of them. We'll share this deck afterwards, but there's substantial information on each one of them. If you would like to learn more about any specific one, again, just let us know and we'll be happy to delve into more detail. And also I'll talk about them according to the quarter in which we made the investment. Before I do that, diversity is something that is innate to the fund. All you need to do is take a look at Lisa, take a look at Lisa and myself. And so it's something that we track. Obviously, because we're just getting started, there isn't that much data, but of the 9 investments that we've made, we're happy to say that there's a great representation of startups that are led by women. We have 1 Black woman in the portfolio. We're hoping to add more.
So far.
Something we've noticed is that, especially for women founders and Black and Latino or Latina founders, capital is a limiting factor. So the small checks that we're able to write now are helpful, but they don't really move the needle when they're trying to raise and don't have the sort of network that other founders have. And so our ability to raise the fund is important.
Can I touch upon that for a minute before you jump forward? Obviously, 2021 was an abysmal step back in capital allocations to female founders. I mean, we had started to make some incremental strides where we were gaining above 3% and we're heading up towards, in some cases, depending on how you count it, 6, 7, or 8% of all venture capital being allocated to women, but now we are back below 2%. And I just need to touch on that because I know that a lot of people are thinking that we need to have more training programs for women or more scouting. What we need is actually just people to recognize their need for access and to cut them a check. It's not, they're good enough, they're better than, and they're doing more with less. So we're really excited about the women in our portfolio and the women of color because we are here for them and can't wait to see them blow through everyone's records. They're not under, they're not, they just need the capital. They're not less than, they're more than, and we just need more people to see that.
Yep. Yep. So the very first investment in the portfolio is in a company called Autonomy. And when people have asked us, why did an investment in Autonomy make sense? I point out that it's something that we understood makes sense because we work very, very hard to keep our ears to the ground. And so what Autonomy does is it's building a platform. It's building a platform for parametric insurance. If the term parametric insurance does not seem familiar, it's because it's an alternative to traditional insurance. So think about the events that just happened in Tonga, and think about if there were a very easy and frictionless way for authorities to make small payments to individuals who could ascertain that one, they live in Tonga, and two, they've survived the volcanic eruption. Think about how helpful that would be. So that's the sort of thing that Autonomy is building. The next investment we made was in a company called Wherewell. And this too comes from the work that we've done to understand what's happening at the grassroots. In fact, I probably would not have understood this as well as I did if it weren't for an episode with my students at NYU, at the School of Engineering at NYU. So what Wherewell does is Wherewell is building a community-powered e-commerce platform. The issue there is that people say they want to shop for sustainably produced goods, but it's difficult to determine which brands or which companies adhering to sustainability principles. And so what Wherewell is doing is building a platform where Wherewell curates these brands and products, and people can shop for them.
And they also offer a service where they curate and can send you a box of things specific to you. So I like to call it the sustainable Stitch Fix.
Yep. The next investment we made is in a company called The Convoy. And this one, again, arose from all the grassroots work that we do. In fact, I met Yassine on Clubhouse, and Yassine designed the logo for our Clubhouse community. But something we kept hearing small business owners who joined our rooms on Clubhouse say is, before the pandemic, they really didn't think about cost savings. They really didn't think about alternatives to traditional insurance and those sorts of things. They didn't realize how important the supply chain is. They just went about running their business. The pandemic happened, and they realized that they're actually in the business of whatever supply chain they need to keep their business running. And so one of the issues that arose is, well, all these big companies get discounts for purchasing in volume. Is there a way for small companies to benefit from that as well? This is a problem that Yassine has been thinking about, and Yassine is the CEO and founder, has been thinking about since his childhood. His dad ran an SMB. And so what the Convoy is building is a digital group purchase platform. Small businesses can sign on, they can make their purchases. The platform combines those into one big purchase, and the small businesses get the benefit of the discounts. Obviously, for providing the service, the Convoy takes a cut of those savings. The fourth one, the fourth investment we made is in a company called True to Form. People on the outside look at this and they think it is a fashion technology company, and it is true that the first application is in the fashion and apparel business. From our conversation with the co-founders, who are sisters, we think of it more as an object scanning and data management platform. And especially as we move to a world in which companies want digital twins of what's happening in their supply chain. We believe that True to Form could become the platform for one, creating those digital twins, capturing the data about what's happening to those digital twins, and then managing them in a simulated supply chain. Obviously, it's early days. This is one of the pre-seed investments that we made, but we think that the prospects for platforms like this is very, very promising.
I want to
Go
touch
ahead,
upon
Lisa.
why we're so excited about this one. So me in particular, I loved their approach to go to market. A lot of, well, pretty much all the other companies that are trying to do anything around this space are trying to match your proportions and body dimensions to existing brand sizes, which is quickly becoming irrelevant because sizing is going to disappear with made to measure and on demand production. So they took the tack of going after or starting with a very niche industry that is actually rather large of costume designs. And so they worked with costumes out of Hollywood for film and TV. And one of their other investors alongside us is the CEO and founder of Sync on Set, the largest costume guild in Hollywood. So it's really relevant because they don't take there's no PII, there's no actual photos of your body, but they get such accurate measurements that costumers are able to have their celebrity stars being scanned and using those dimensions to create costumes. It's really important for that industry because it's really expensive and hard to get celebrities there physically. I've actually introduced them to a fashion designer that I know that works with Lady Gaga, Lil Kim, Nas, Taylor Swift, Beyonce, and he is super excited about their technology. He's already started talking to them and is working with it to replace all of the body scanning technologies he's used. This designer has literally invested in buying physical scanning booths for bodies and has created physical twins of celebrities like Lil Kim because her proportions are definitely not your average size or fit. And he's really excited about working with them because he believes the future is made to measure. And this technology, he said, looks like the best he's seen and worked with to date. So I'm excited.
Backbone is building a frictionless data network to enable intercompany automation and interaction. Again, this comes from some of the community building work that we've done. We've known Rob for years, starting with when he first attended one of our meetups. And in fact, he will tell you that his discovery of this problem as something that's worth solving started through his participation in the meetups. What Backbone does is the industrial space, right? So these are companies that sell industrial machinery. They have a lot of parts. Each of those parts has information associated with it. But the way that business happens in that space is through interpersonal interaction. Now, because of COVID, it has made it difficult for people to do business in person. A lot of that business has had to go to e-commerce, but that's impossible if you don't have data and if that data is not synchronized in real time. And so what Backbone is building is a platform to make that possible. Lisa, do you want to talk about Simply Fiber?
Oh, sure. Simply, Simply Fiber is a company that actually was founded by Maria Insher Aurang. She was the head of design at Vera Wang, Calvin Klein, Eden, and Alexander McQueen. And I met her a few years before COVID at a lunch with a mutual friend. And she told me after that lunch that she had this idea for building, for entirely changing how you produce fashion. And she told me later, she started this company because she met me, because she didn't know before meeting me that there were any investors or even community to support companies that weren't SaaS only plays. And her product, her innovation, is going directly from cellulose-based fibers to finished garment without needing to create thread, to weave textiles, to cut or sew. So all those steps in the process that has been around for, the beginning of time, are now changing and going directly from the cellulose-based fiber to molded or 3D printed garment in 2 steps. It's never been possible before, but she is making it possible and has already gone through the Heritage Group Accelerator program for Techstars.
Techstars.
I introduced her to Adidas, and within a week they started giving her non-dilutive grant money for R&D. It really is a game-changing innovation for the planet that we're on, because it's single fiber and you can do a full soft draped or change the properties with different applications like Drapel, or making it waterproof. It could be scaled for both commercial and consumer products, medical, even with hospital gowns that can be waterproof and biodegradable after single use. It's exceptional. So proud of them.
Leaf Logistics is a company that we've known for a while, going back to early 2017. And Leaf is building a platform. Actually, the original name was Logistics Exchange. Um, uh, but there was an issue with email filters, and so Anshu decided to change the name to Leaf Logistics. But basically, the problem in transportation is that there isn't a contractual way to enforce a service that you have contracted for, and we're seeing this play out now. If you listen to shippers and carriers talk about what's happening in the container shipping market, you think you have a contract for a service from China to Los Angeles, and then someone comes along and is willing to pay a higher price, and you no longer have that service. And so the original idea was to create an exchange using derivative contracts, to enforce some of those relationships and manage risk. The idea has since grown from that original basis, and now what it's becoming is an innovation platform to enable large companies manage their freight logistics needs. One exciting thing about Leaf Logistics is that there really isn't anyone else that is trying to do this. And so if Anshu and the team succeed, this is the sort of thing that could become really dominant on a global basis, because the problem is a problem that large companies everywhere face. And so far, the results are really promising. Some of you might notice that this is a pre-Series B investment, which is quite late for a small fund like ours. But the thinking we did before making the investment is the upside from this point still large enough that if Leaf succeeds, our investment could return the fund. And our answer, after thinking through all the possibilities, was yes. If Leaf succeeds from this point, our investment could definitely return the fund. Ship Day is another investment that we made. And the way I'll describe Ship Day is that Ship Day is doing for local delivery what Twilio did for voice over IP communication services. So before Twilio, if you wanted to build a voice over IP communication service, you had to do a lot of very complicated programming. You had to build the technology yourself. Twilio came along and changed all that. Now you could just use the APIs and the platform that Twilio built, and you could be up and running in a very short amount of time. ShipDay is doing that same, is providing that same capability for local delivery services. The way to think about it is that as many of you know, companies that rely on Uber Eats, on Postmates and DoorDash and similar services are at the mercy of those platforms. And in fact, the services that those platforms provide is not viable from the perspective of profitability for the local businesses that use them. Mainly because the business model for Uber Eats and Postmates and DoorDash does not really fit into the revenue structure and profitability structure of the companies that rely on them. And so you use them because you have to, and your companies want things delivered to them, and your customers want things delivered to them locally, but generally you're doing that at a loss. And so what ShipDay does is, if you want, you can still continue to use Uber and Postmates and DoorDash. On the other hand, if you have your own drivers, ShipDay provides you the tools with which to create and manage your own delivery service. And what that means is that now the delivery service you provide your customers can actually be a service that fits into your revenue model, that works in terms of your profitability structure. You can charge what is appropriate so that you're not losing money. Instead, you're making money, or at least you're maintaining your profit margins. We think it's an exciting new development. We think in the United States, it obviously has a lot of promise, but I have said to Moin a couple of times that I really think where he's going to see a lot of growth is in places outside the United States, right? Places where Latin America, Africa, Southeast Asia. I think he's going to see a lot of growth there. So that is ShipDay, and that is one that has had COVID as a tailwind.
Yeah, I think it's important to note also that ShipDay and the Convoy are both sort of touching upon the small is the new big trend, that all of these small businesses are more and more so becoming the power of the economy at scale, because they're collectively building their power and resources.
Yep. The final investment we made before we ran out of capital and had to stop making investments is in a company called Stimulus. And Stimulus is another one that I really came to understand the value of as the pandemic unfolded. So incredibly, as important as sourcing and procurement are to any business, a lot of the tools that the sourcing and procurement teams use, so Excel, paper and pencil, email, and other tools of that nature. And so what happens is that in a time of crisis, and we all experienced this when we ran out of PPE, and organizations and even governments could not find new sources of PPE. What happens is that during times when the economy is in a normal state, sourcing and procurement are highly inefficient. Two, when the economy is in a crisis and your normal relationships for sourcing and procurement are non-functional, then things can fall apart. And so what Stimulus is building is a platform that enables large enterprises to better manage their supply and vendor relationships. This is an enormous market. Public procurement is about $13 trillion in value. According to a report by Goldman Sachs in 2018, the value of corporate business is $120 trillion to grow to 200 trillion by 2028. All of that value, all of that business between companies or between governments and private companies requires some form of sourcing and procurement at some point in the business relationship. And so we're very excited. We're very excited to be investors in Stimulus. We had to warehouse the investment in Stimulus in Q4 of 2021, but the transfer into the fund is in progress. And so Stimulus is probably going to be the first company in the Q1 2022 portfolio. And that is it in terms of investments. Based on those investments, we're now investors alongside funds like Dynamo, the Heritage Group, Supply Chain Ventures. Dave is on the call and is an LP in the fund. Thank you, Dave. FICA, Newark Venture Partners, for whom I'm a venture partner on their supply chain and technology investments. My friends at Boldstart, Schematic, Techstars, and a few other funds.
We're excited to add to this in Q1. We've already got some great deals.
Some big names, yes.
Alongside some stupid large global investors, and our little 25K check is making the cut.
So now we'll talk about the fundraising update. One of the things that another rolling fund manager has said to me when we've been catching up is fundraising is fundraising. It doesn't matter if you're doing it as a 506c fund or a 506b fund. It doesn't matter if you're doing it as a rolling fund. So we're still under the $1 million mark. For Q1 2022, we have about 180K available, and that means that we'll make something like 7 investments, and that's if no new LPs sign up. We're expecting some new LPs to sign on this quarter, and there's plenty room for more LPs given the flexibility of AngelList's platform and structure.
I'm going to make a shout out to everyone on this call that we don't want to have to miss out on the 20 plus deals we have in diligence. It's not like that's our entire deal flow. Those are the best of the best that we're really excited about. And what's really personally painful for me about the rolling fund vehicle is that when you are tapped out for the quarter, you are done. So we have 7 deals out of the 20 that we're really excited about. So we need more capital to deploy in Q1. Shake your sofas out and call your friends.
The other update on fundraising is that
hey, Brian, this is Zach. Can I just ask a quick question there?
Yeah. Jump in. Zach.
How much capital do you want? I mean, what's ideal for you all right now? I mean, you can't say unlimited. That's not an answer.
Yeah. So Zach, thank you for asking that question. It's a fantastic one. So the ideal scenario is that we're managing an institutional fund, just based on the size of the opportunity that is supply chain tech, and based on our understanding of how things are going to unfold going forward. In terms of the rolling fund, we have always thought that the rolling fund is ideal for accredited individual investors for whom, the way that a traditional fund works is not very appealing. And so for the rolling fund, we've thought if we could get it to $10 million, that would be fantastic. if the interest is enough, maybe we'd let it grow up to something like $20 million, right? So $10 million would mean that from the rolling fund, we're deploying something like $2.5 million a quarter from the rolling fund. I was just about to say that we've begun conversations about an institutional fund. Our target for Fund 1, the first institutional fund, is something in the $50 million range. The way that we're thinking about it is that the institutional fund would be, for traditional institutional investors, so corporations, endowments, foundations, and family offices who don't really like the structure of a rolling fund. And the way we think about it is that there would be sidecars to one another. So the rolling fund would be a sidecar to the institutional fund. They'd invest in the same deals. They'd invest on a pari passu basis. We'd speak with the attorneys who work on the docs for the institutional fund, so that at no point is the rolling fund at a disadvantage to the institutional fund. And I think most importantly, the same team that makes investment decisions for the rolling fund would be the same team that's making the decisions for the institutional fund. So essentially, you can think of them as one vehicle. And if you're a little patient, when we get to the appendix, I can talk a little bit about how big this opportunity is.
Or I will ask Zach, if you were asking about for Q1, how much capital we actually need to invest in all the amazing deals. It's about 500K.
Okay. All right. And yet you guys are able to kind of right now deploy about, what would you say? I missed it earlier, but about 200K?
Yeah, roughly.
So it's 7 out of the 20 deals.
Yep.
Right. Okay. All right. Sounds good. Yeah, I mean, I think, and the way you're explaining it, Brian, is that basically, if you see this institutional fund, it's almost like the rolling fund becomes the sidecar to the institutional, right?
That's exactly it. That's exactly it.
Yeah.
That's exactly it.
Okay. But short term, adding in another, $500,000 a quarter or something like that would be like $3 million into the overall annual fund would be, give you guys the powder you need to take what you see on the table.
Yeah.
Yes. Yep.
Okay.
Yep. So I pretty much talked about the institutional fund. We're happy to provide more information if anyone wants it. Something we did late last year was work on this report. And it was based on a number of articles in the media that suggested that family offices are putting venture capital funds out of business. And so we dug into the topic and concluded that it actually makes sense for family offices to partner with emerging VCs instead of trying to put them out of business. And
I forced Brian to take his 39 pages of edge to edge, no margins, 10-point type single space text to turn it into a readable 80-page white paper. So I hope you all enjoy it and can actually read it now.
So now the macro environment, and I think at this point, we've done most of the talking up to this point. I'd really love for you guys to jump in. But in terms of the macro environment, it couldn't be more promising for what we define as supply chain technology. And, just very briefly, when we say a supply chain technology, we mean all the technology that is required to enable and facilitate and connect whoever is producing something with whoever wants to consume it. And that means that for us, we understand this to be supply chain management, supply chain logistics, as well as supply chain finance. And we think of it across all industries. So when you look at it that way, then as far as I can tell, the macro environment is really promising. For one, it looks as if trade tensions between China and the United States, China and Russia, Europe and China, Europe and Russia are going to keep increasing. Just a few days ago, this article was out in the press that says a government-backed think tank in China sees the targeted decoupling of supply chains with the West as one of the top 10 risks for 2022. And so what that means is, even if we took out the effects of COVID, there would still be instances in which companies and governments in the West have to rethink their supply chain dependence on China and the East.
Let's go through all the macro. Here we go.
Yep.
Yeah.
Yep. The other thing that we find to be interesting is that a lot of other investors are now piling into supply chain technology, and not just venture investors, but investors of all kinds at every stage, at every stage that one can think of. So according to this article, I think supply chain technology in 2021 attracted something like $24 billion of investments, which is a record. One thing that we notice is that a lot of the time when reporters like Jen Smith, who wrote this article, or even other investors are talking about supply chain technology, what they really mean is logistics. And so our argument is, if all you're looking at is logistics, then sure, it's a big opportunity, but you're still not seeing the full size and scope and breadth of what supply chain technology is, right? Because what you're focused on is that aspect of supply chain which involves storage, movement, and distribution. And no doubt that's a big part of supply chain, but it's not the only thing. And so as great as the news sounds in terms of the investments that are coming in, we think that the opportunity is even bigger.
Yeah, I'll add to that we're happy to see other funds coming in, but also it's a little well, I guess it's disheartening, but also good for us, yay, that they're not quite seeing the forest for the trees. They're still so hyper focused on individual silos, which are also further amplifying a lot of greenwashing and companies saying, well, we asked the industry what we should be investing in, and funds asking the industry or thinking that they know because they come from the industry. But the most important thing to really have your finger on the pulse of right now is what the future is going to be and what's replacing the existing paradigms, because this industry is undergoing such massive creative destruction. You can't possibly invest in incremental solutions and think that they're going to be existing past the next 5-10 years. There's going to be entirely new paradigms built to replace what we already know.
Hey, Brian and Lisa, it's Mark. Just one question around the inflows of capital into logistics. Are you seeing increased competition for deals that you're excited about in that kind of sub-vertical of supply chain? Or are you saying that, yes, there's capital flowing into logistics, but these are deals which are, per Lisa, incremental in nature, and you probably would have skipped over them anyway?
I'll say we are thrilled that we have some of the best deals around the world reaching out to us despite having the largest Silicon Valley funds or the top global names on their cap table. They're saying, no, 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 we've set aside a slot for refashion because you guys are the only ones that add value. Which yay. So we are in a place of privilege, being able to pick and choose amongst the best of the best deals. And the incremental stuff, I don't think would have been something of interest to us anyways.
Yeah.
We are truly deep in understanding what's going to be replacing all of those incremental steps. And, you know, a lot of other funds aren't, and they can blow their capital in those and we'll be building what's next.
So I'm going to. It's rare that I'm the diplomatic one. Usually Lisa is the diplomatic one, and I am the one who's a little more blunt. But so, Mark, that's a great question. So far, we are finding that when we make up our minds to invest in a company, we can usually make the investment, and it's for all the reasons that Lisa gave, right? That when we have a number of conversations with the founder, they realize that we've spent a lot of time understanding the opportunities in supply chain, the potential risks. We have a sense of the issues that the current customers or potential customers are worrying about. And so that really sets us, it puts us in a different category from a lot of the other investors that they've spoken to. And so, for example, in some of the cases in which we've wanted to make an investment, someone on the outside would be like, well, that round is oversubscribed. Why does the founder, why is the founder still talking to Refashioned, right? And usually they're saying no to someone else and making room for us. And so, you know, our thinking is when we have more capital to deploy and can lead around or co-lead around or be a significant check in a round, we will be even more attractive at that point. We're also getting outreach from founders in other parts of the world. For the near term, we're focused on startups in the United States. And so in those cases, what we're doing is we're using our network to connect them with other investors who perhaps are based in the US and invest internationally, or in some cases, we're connecting them with investors outside the United States who have expressed an interest in what they're building.
I hope I answered
your...
out
Yeah. No, go ahead,
that
Lisa.
diversity, our diversity is also a massive strength. I mean, just looking at the two of us, we're pretty different, people of color, woman, man, and I've been on calls with female founders of color that have said to me, you know, my round is way oversubscribed, but I'm just in awe that I finally get to have a VC on my cap table that looks like me, that's been through raising capital as a woman of color in this space and knows the ins and outs of it. There's something really powerful to be said about that. And every time I'm on a call with a female founder, especially female founders of color, it really strikes me as a place of privilege that I can act as representation for them and guidance and support, frankly, that they haven't found elsewhere.
Mm-hmm. Mm-hmm.
Great. Thanks, Lisa. Thanks, Brian. Very comprehensive answer.
Thank you. Thank you. The other issue that we feel is a macro tailwind for supply chain technologies, COVID-19, right? So even though there are vaccines and even though it seems as if the world is finally getting its arms around the pandemic, the truth remains that there is still a lot of uncertainty. There's still a lot of uncertainty. We do not know yet what new variants might be discovered. And there's still the question about whether the vaccines that exist will work if there's a new variant. And so what that means is that companies and governments and individuals are still trying to figure out what this means for them. In the case of companies, it means that they're going to continue investing in the innovations that they require to enable their employees and their supply chains and their value chains function in this new environment. By some estimations, the disruptions in supply chains might continue for another 18 to 24 months. And what that says to me is that if we consider that these disruptions started in early 2020 and might continue till sometime in late 2023 or mid 2024, then by that point, some of the changes that are occurring would have been set in place, right? Companies are not going to make these investments to adapt how they do business in this new environment and then rip those all out and replace them with something else. And so I think that is it's a very promising environment for the sorts of technologies and innovations that we will be investing in.
Yeah, and COVID-19, let's just point out also, it's a symptom, not the root cause. Once we get through the disruptions that are related to this pandemic, there's going to be another and another and another, because the root cause is climate crisis. And this is not going to go away anytime soon.
Yep.
Climate crisis. So speaking of, this is one of my favorite topics because when I first met Brian in 2016, I had just come off of a year of deep study of the apparel supply chain and wanted to understand how we could better refashion it to account for the overproduction that's baked into our volume production overseas and our globalized infrastructure, the fact that we've addicted consumers to fast fashion and the rate of churn on thousands of new products being launched every day by companies like Shein out of China is untenable. Our planet is at a breaking point because of this industry and the toxicity of the fibers that are used. So I was recently quoted in an article for the Lodestar talking about localization and reshoring, which was my whole thesis when I first met Brian, that the only thing that we can do that makes any sense, given all of the insanity of the current supply chain, is to refashion it to localized demand chains, and demand chains being on-demand production where you produce a volume of one post-purchase and your volume shifts to your raw materials. So your raw materials can become local regenerative textiles using post-consumer waste or other regenerative fibers that we can keep circulating. It's truly a circular infrastructure, and it looks like the rest of the world is finally now really leaning into this. Just in 2021, at the beginning of the year, there were articles stating that 63% of companies were looking to nearshore or reshore. By, I think it was October, it was something like 83% of companies. And as of this article, which was in December, 90% of companies in the McKinsey study were looking to reshore or nearshore within the next 3 years. So it is accelerating. It is definitely a massive trend, and it's going to create local jobs and a sustainable local economy. One other article I put up there is the legislation, because legislation has been dropping all across Europe for sustainability and circularity across industries, but specifically for fashion. New York has this amazing legislation that they're looking to lead the United States on dropping sustainability recourse if you aren't accountable for your end-of-life textiles and your toxicity in production. True traceability and accountability for your production. Breaking points. This is one slide I added in because this article I posted on LinkedIn has become a bit of it's taken off. we are now in the domestic pirate stage of our supply chain crisis. And this is just a compounding issue with our ports and the bullwhip effect. And now it's all of the things. Our tagline is the world is a supply chain because everything impacts everything else. And to me, this really highlights that. Our society has become so split between the haves and have-nots that we have people that are now before Christmas, I think it was the breaking into Louis Vuitton stores and Prada and walking out with hundreds of thousands of dollars of merch. And now they're literally looting trains when they start to run slow through LA. Everything from UPS, FedEx, and Amazon inventory just torn apart, dropped on the tracks if it's not of value. And this is costing companies, I think in the article it mentioned somewhere around $5 million so far.
Yep. So that's it in terms of what we planned for the update. If there are any questions you'd like us to discuss, we're happy to do so now. And if you have a question, just feel free to unmute yourself and go for it.
Dave.
Brian and Lisa, is the rolling fund going to do follow-on investing in your current portfolio companies? How's that going to work?
That's a great question. So when we originally thought about it, we thought the rolling fund would not make follow-on investments. But the truth is that AngelList makes it possible for us to do a follow-on investment if we want to. What we'd have to do is first, we would make the ability to do a follow-on investment open to the LPs in that quarter. And then if those LPs pass or don't take the full allocation, then we can make it open to other people. It's a conversation I need to have with our VC associate at AngelList, but the opportunity to do so is there. Did I satisfactorily answer your question, Dave? Thank you.
I'm curious what topics are most prescient for people on the call. What are the things that keep you up at night? I'm gonna call on people. Zach.
That's cool. Yeah, well, I have lots to say on many topics. So my area of interest on at least related to this has been fascinating. I've just been learning, and thanks so much for all the updates. And you guys are doing great with your content writing and just like, raising and bringing your guys' perspective in a public forum. So that's great. For me, I'm most interested right now. We see this big movement of businesses moving to kind of, I'm going to call it as a service models, which really what that I see that as is like, kind of hiding and collapsing, a lot of the supply chain efforts behind it. We see it in our industry, which is, I work at the world's largest data center operator. And when people say as a service, whether it's cloud or to these types of things, what they really mean is handle all of that supply chain stuff for us. And the area that I think, there's relatively little tooling around that. There are some big businesses that are trying to verticalize within it. Those are kind of the clouds or the technology businesses like, a Dell or whatnot. But the area that I see is fascinating is that, we have about 10,000 enterprise customers, and the vast majority of them have stated towards kind of their sustainability goals around scope 2 and scope 3 emissions by 2030. And yet like there's no way for them to capture this, supply chain. They're just kind of rolling it downhill and like kind of assuming that it's going to be free. And that's an area that I'm most interested in, as well as keeps me up, right? Because I don't see the tooling and the related movement within the industry to move fast enough to even be able to report on it, let alone do anything about it. So curious if you have seen some stuff within your guys' portfolio, the deals you look at that are trying to capture the scope 2 and 3, carbon footprint of the supply chain and expose that in ways that companies and people who are in different layers can take action on it. or at least be aware of it and measure it.
Yeah.
That is a fantastic, it's a fantastic question. The honest answer is we haven't seen anything that is compelling. We haven't seen anything that is compelling, at least not yet. There was one company I spoke to, which is based in London. On the surface, it looked interesting. Because they're based in London, we couldn't do much more work on it. I need to follow up with them and see what's going on there. But as you know, Zach, capturing data on scope 2 and scope 3 emissions is incredibly difficult. And so my guess is that it's likely going to be a year or two before the innovations exist to do that in a meaningful way. But we're keeping track of what's happening. We're looking for deals in that space. If you come across anything you think is interesting, please tell them to come.
I'll tell you right away.
Brian, and tell them
Brian.
Yeah.
Brian, it's James. Can you hear me?
Yes. Yeah. Hi, James.
Yeah. Zachary, that was a really interesting question. I mean, we support about 100 construction companies and owners globally doing logistics and supply chain. And even if the technology existed today, just the behavior change requirements with a lot of construction companies and their subcontractors is so vast from where it is at the moment. It's going to take 5 years almost before this is all done in a meaningful way, which is going to be a real challenge when you've got these net zero ambitions for 2030 or sooner. And I mean, our customers don't even know how much of anything they're buying, let alone what the embodied carbon is. So
exactly.
So it's yeah.
We see the same thing. And I was going to ask, do you then separately, because these types of, Brian, Lisa, from my experience, these types of like super crazy big cross industry, cross participant, cultural change movements generally don't happen because like a vendor creates some like magical SaaS platform and then gets like huge amounts of the industry had to adopt it, because like we can't even change out our ERP system in 5 years, let alone like, change the way we do that stuff.
Yep.
So like, have you seen movements or have you guys focused any of your efforts specifically towards open source or commercial open source businesses in this where like it works best? Because what hit on me is like your interconnected like problem set, Lisa, that like supply chains are inherently interconnected. Like trying to like top down design those is like, I think like futile. You have to allow them to get adopted.
I will put out there what I've been working on, my side project, Refashioned OS. I don't think top down or I'll call it bottom up full redesign or refashioning of certain supply chains is impossible. I think it's actually way more possible and viable than trying to retrofit our current globalized infrastructure with billions of nodes that have transparency, or shall I say opacity, being a feature, not a bug of the current system, because they don't want to know beyond their tier 1 really what's going on. And so for fashion, I arrived at this solution of us localizing our infrastructure. And what would that really look like? If we are to localize all production of the most ubiquitous items, starting with the most ubiquitous fibers for American consumers, what would that look like? So you have to start with the constraints instead of starting with infinite optionality, which is a primary driver of global markets. Especially first world consumers are addicted to this infinite optionality, within 5 minutes delivered to my house. And that is the primary thing that is, for most people, the sticking point. Can we keep the same price points, variable features and options and speed? So it does require refashioning an entire end-to-end infrastructure to achieve it, but it is possible. With fashion, we have fibers here in the US, cotton, hemp, bamboo, even some sustainable regenerative PET that are being sourced locally and then milled locally. Because the only product that is worth anything to your customer is the one you can put into their their hands. And so it's especially driving more and more fashion brands to look into made in the USA production. But the current paradigm of producing volume and just bringing it from China over to the US is not competitive enough in pricing. So you need to integrate automation within the model to be able to get the unit economics to work out and have it be post purchase, rather than producing in volume and hoping that you sell through uh, all the inventory that you've produced. That's never going to happen. The current model is 30 to 40% of products produced are just landfill or incinerated, just because you can never get good enough at guessing the sizes, the prints, the colorways, or variables that the consumers are looking for.
Zach, I'll look at it another way. And I noticed that there are some topics in the chat. I'm not monitoring the chat window. So Lisa, if there's anything,
yeah,
if there's anything in the chat that we should address, please let me know. So Zach, I think what it's going to take is a little bit of both. And I'll explain what I mean in a short while. So there's a book I really love called The Disruption Dilemma. And the thing I love about the disruption dilemma is that it synthesizes two aspects of disruption. One that we pay a lot of attention to because that's what the media and the press pays a lot of attention to, and one that is less well known. The first one is, the Clayton Christensen form of disruption, which is you as an entrepreneur notice that there is a group of customers who are not being well served by the incumbent products in the marketplace. So you produce something, usually it's at a lower price point, fewer options, and lower quality, so to speak. You gain a toehold in that market, you start to grow, you improve the products, and suddenly you're stealing market share from the incumbents. There is another form of disruption, which interestingly was also formulated and researched by a professor at Harvard. And that is, so the Clayton Christensen form of disruption is the demand side disruption, right? You notice an issue on the demand side of your business, you start to satisfy that need, and that's how the disruption takes place. The other form of disruption, which is just as powerful, is a disruption that occurs because due to advancements in technology and innovation, it becomes possible to do things in a completely different way than they've been done in the past in an industry, right? So think of what the iPhone represented in the cell phone market, right? So we went from you need to have keys on the phone to you just have a pane of glass on the phone, and people type on this pane of glass. And what happens in that case is it's not an issue of needing to satisfy some form of demand, but the issue is now you're creating a supply in a completely different way than incumbents are accustomed for. It turns out, at least in our reading of how this works, is that disruption really happens when you have those two forms of innovation happening at about the same time. So on the one hand, you have a group of startups, a group of companies that is creating a demand side innovation. On the other hand, you have a change in the way that an industry or a sector can meet the demands of supplying what they supply to the market. And I think the thing that I personally find really interesting about supply chains is that we're coming into one of these periods where we're going to see those two forms of things happening, right? So on the one hand, we're going to find that AI and machine learning is used more extensively than it was in the past. We're going to find that cloud computing and edge computing and quantum computing is going to be used more extensively than it was in the past. We're going to find that 3D printing is used more extensively than it was in the past. We're going to find that more and more customers are unwilling to patronize businesses that they perceive as doing harm to the environment. And so that's going to force companies to rethink what their supply chain looks like. At the same time—
Another big trend, I just want to add in another big trend that I'm seeing everywhere is distributed networks. So people are leaving the whole centralized model and having giant, we put all our eggs in the China basket and they're no longer selling eggs. So we're looking at having a distributed risk and a distributed footprint of your infrastructure partners for localized regions, so that if you have, say, in the United States, California having wildfires and your one big factory was in California, you're screwed. But if you have a network of smaller micro factories in California, Ohio, Texas, New Jersey, you can just send your orders to the next closest facility and you have zero downtime. You're distributing your risk. So that's becoming a lot more prevalent.
Yeah.
And smart.
Yeah. And so it's a combination of these two things, right? Which I find exciting and compelling about what's happening in supply chains. And again, that's why when we look at investments, we're thinking, where is this going to be? If they succeed, where is this going to be 5 years from now, 10 years from now? And we're less excited about the innovations that seem like, this is going to be fantastic in the next 2 to 3 years, and then something else is going to come in and supplant it.
Yeah.
Hopefully that made some sense.
If anyone wants a deep dissertation on localization, I'd be happy to give it to them. My LinkedIn URL from my personal page is literally supply chain localization instead of my name. So that's been my jam.
Zach, did that make sense?
Yeah, I mean, it did. I guess what probably it's not the right forum for this, but I'd love to tug on it a little bit, since two of the themes I like to invest in are specifically around sustainability and open source. And so I'd just like to discuss that more. But yes, I appreciate your guys' perspective for sure.
Yeah, I think the biggest fail point in reporting still is human error. Like, we need to, one of the things I liked about the thesis of localization is that it's a lot harder to, have bad actors if you can literally drive and call them out. So it's about getting the right data, but also the right types of data reporting. And for me, at our micro factories, we're looking at ways that even our seamstresses won't have to be accountable for entering their SAM minutes of usage and what fibers are being used. All of it is data that is now being captured and attributed to the raw materials and each employee, and monitoring the flow of stuff across the operating floor of a factory is being automated in ways that have never been possible before with computer vision, machine learning, and AI. So I'm really bullish on ways that we can automate data capture to take out the human error.
Any other questions?
We have a late entrant, Vince Coley, just as we're about to wrap up. Any other questions? Peter, it's been too long. I just want to give a shout out. So good to see you. I miss having our local community, at all of our events. It's been a while. Oh, so good to see you. And Danielle, hi. Man, we were looking at our our deck and the pictures of us at SAP from early days of the New York Supply Chain Meetup, and oh my God, do I miss it. You guys, every month it was like family reunions.
Daniel, thoughts, comments, complaints?
I love the update. Thank you for that.
Thank you.
You know, from my sort of supply chain lens, you know, it certainly seems like you're hitting on the right themes, the things that people are talking about and are concerned about, and I really see both of you as I'll say niche subject matter experts who I think are truly going to be influencers in this space, are and will be. And so I think that's a great position to be in when you combine that with, you know, larger funds and family offices, all of a sudden, you know, trying to jump on board and look for supply chain stuff. I think you're perfectly positioned to be, you know, identifying the really high potential new innovations, and being a leader and being able not only to add value to those larger funds, but really to the startups that, you know, have the high impact opportunities and need not just, you know, our check, but some of the bigger checks to follow on. So I'm excited about it. I just, it really feels like you guys are in a terrific position. So thanks for letting us come along for the ride.
Thank you, Mr. Supply Chain.
Thank you. Thank you. Any other questions or comments? If not,
I see Rachel Fishbein on here. She's been on mute, but I'm really curious, since I know this is the first time she's been joining a Refashioned LP update, if she has any thoughts. Sorry to call you out like this, but sorry, not sorry. Rachel.
Hey, sorry, I'm in a bit of a multitasking stage right now. Yeah, no, I think this was a really, really great update. Thank you guys so much for including me. I do think, you know, we're going to have to continue to think through what the demand is going to be. You know, like you said, I'm curious about whether or not we're going to be able to shift the tides of consumers to localization and to kind of not having it all on demand to make it work at these kind of micro manufacturing spaces. So sort of yet to be seen, because it's interesting, you know, as we sort of look at consumer behavior, you know, there's a lot of interest in sustainability, but it still has to look great. It still has to be at an affordable price. And so, you know, it's always like, it's a plus, but generally not the determining factor if they don't get exactly what they want in other aspects of the products.
Yep. Yeah, it absolutely is about a collaboration with the right brands and finding the early adopters. One interesting thing that I think is mind-boggling in this space is when VCs ask early stage supply chain companies, well, what are the enterprise legacy companies? How are you going to get them onboarded fast? What other industry would you ever ask an early stage company what they're how they're addressing the laggards? Like, the laggards shouldn't be your first market to try to tackle. It really is understanding who the earliest adopters are and who's going to get you over that the great divide to eventually getting the laggers on board. But disruption that is cheaper, faster, better, and sustainable is always going to win. And I think it's a matter of more and more industries having the bravery to start to intentionally refashion and redesign their infrastructure to be intentional about the outcomes, because it doesn't happen by accident. I feel like we've all sort of thrown up our hands saying, well, it is what it is. I have no control over my supply chain. Well, that's not true. It's yielding exactly the outcome that you've currently have it designed for. And if it's toxic, at risk, and, can't be traced, that is by design. You need to intentionally think through how to reallocate your resources and seek out the companies that will help you achieve the outcomes you're looking for, because it is possible. It takes intentional design.
Yep. Any other comments, questions? If not, I will.
This is Peter. I'll jump in.
Ahead,
Yeah.
Peter.
Something that's been on my mind recently, and I just heard the most interesting aspect of it this morning. So the Infrastructure and Jobs Act is, I've been looking at that thinking, good heavens, there's going to be a whole bunch of money dumped into infrastructure, which is supply chain, which is logistics, as you mentioned, Ryan. And I was thinking, who's figuring out where the money should go? And it strikes me that like the companies that you're investing in certainly could be candidates for some of that money. And I've been wondering, like, how is this being allocated? And I talked to a startup this morning that actually the FMC has reached out to them to get their perspective on the Infrastructure and Jobs Act and how they might play a role and what their ideas are around a role that a startup could play in that. So anyway, kind of a shout out and a call out to all the startups that are out there that are tackling these things. I mean, we're all going to tackle little pieces of it, and there's a real opportunity to make the connection with this infrastructure group to make sure we're in there helping.
Brian, that brings up a good point. I've been meaning to schedule a follow-up with Donna Harris from DC. She worked directly with the White House in the Obama administration, and she was the founder of 1776, and now she's the founder of, I think it's called Builders and Backers, to build infrastructure and create jobs here in the United States. So I think sitting down with her, we can get refashioned at the table.
Yeah.
Awesome point, though, Peter.
Yeah. Thank you, Peter. We've kept everyone for longer than we had originally planned, but that
we could talk about this for days.
It seems to always happen when we're talking about supply chains. So on that note, thank you all for joining. We're going to publish this on YouTube, and we'll send a link to the video and a link to the deck when those are available.
Sounds good.
Thank you.
Happy Monday, everyone.
Thank you.
Bye.
Bye-bye.